right, guys, I'm gonna try to knock this out on the first take. My name is Everette Taylor. I am a serial entrepreneur and marketing executive. I am here today with QuickBooks for their Ask the Expert series. Today, I will be talking about the dark history of lending discrimination here in the US, specifically towards Black-owned businesses and minority-owned businesses. I will also be speaking on the several options that you have as a small business owner to seek financing for your business. So let's get started. First, I want to take you back to Richmond, Virginia when I was a kid. And the first time I really realized the discrimination that minority-owned business owners faced. I grew up in Richmond, Virginia in the South Side, but on the North Side, there was this neighborhood called Jackson Ward. And when you would hear people talk about Jackson Ward, they would talk about the history of Jackson Ward and what it used to be. And because Jackson Ward at that time was really torn down and it didn't look great. And so it was hard to believe all of the things that, these people were telling me about Jackson Ward. Jackson Ward, they told me about how Jackson Ward was known as Harlem of the South, where all of these Black business owners thrive. You had Black-owned businesses all throughout the community, from banks to barbershops, restaurants, newspapers, you name it. You had Maggie L. Walker, the first woman to own her own bank, and she happened to be a Black woman. All incredible. Until the 1950s, when the government proposed low-income housing and a new interstate that displaced Black homeowners and business owners. And due to this and other racially discriminating laws and business practices, Jackson Ward suffered, including redlining, which I'll get to in a second. I think about Jackson Ward often, and the reason that I think about Jackson Ward is I think about the history of so many Black business owners who wanted to make a living for themselves and their families, and they couldn't due to discriminating practices that only had to do with the color of their skin. Now, lending discrimination happens when lenders base credit decisions on factors other than your credit worthiness. For example, the color of your skin. Also, there was a practice called redlining, where lenders would literally draw red lines on a map to indicate neighborhoods or zip codes where they would not lend money. And to no one's surprise, these neighborhoods were predominantly Black populations and Black-owned small businesses. Now, in 1974, there was the Equal Credit Opportunity Act. Say that 3 times fast. Which was a game changer for many Black business owners. It aimed to give all individuals, no matter their race or background, an equal opportunity to obtain loans and other types of credit from financial institutions. Lenders could no longer impose different terms on your loan, like higher interest rates based on your race or other discriminatory factors. And trust me, they would find them. But even with protections like this, obstacles still exist for Black-owned businesses to access capital. In a recent study, 39% of all non-employer firms reported their funding needs were met, while only 17% of firms with non-Hispanic Black ownership reported that their funding needs were satisfied. That's a huge, huge gap. So, moving forward, what options do you have? Well, I'm here to tell you. The first is traditional bank loans. A traditional term bank loan, including loans from the Small Business Administration, are usually paid back incrementally over a fixed period. Let's say usually 1 to 10 years, right? They remain attractive options because of their competitive annual rates, right? So what are some of the pros and cons of traditional bank loans, right? That's if you go and walk into your local bank today. You're gonna have lower interest rates than other financing options. You're gonna have the ability to build your business credit, which is important, and you'll have assistance from a banker or loan officer, right? The cons is it's harder to qualify for a traditional loan. You require a strong personal or business credit score. So if your credit is a little jacked up, might not be the best option for you. Banks also prefer to make bigger loans and larger loans. So if you need smaller loans, it might not be the best option. And there's a slow application review process. And also startups and online businesses are less likely to get funded. They're a little bit old school there. The next option that you have is business credit cards and credit card cash advances. Getting a business credit card can be relatively easy, but they're best for small purchases that you can pay off before those high interest rates kick in. So what are the pros to this? The pros, they're relatively fast and easy to get. It doesn't require money in your bank account and usually no credit checks. The cons, super high interest rates. There's usually additional fees, 3 to 5% of the total amount advance, and it can negatively affect your credit score if you miss your payments, and no one wants their credit score affected. The next option is crowdfunding. So you have funding platforms. I'm sure you guys have heard of things like Kickstarter. This enables entrepreneurs to solicit donations from a wide range of backers, usually in exchange for a reward, right? You set your funding goal and deadline. If people like the project, they can pledge money. What are the pros to this? Less financial risks, right? There's also potential for the campaign to go viral. I'm sure you guys have all seen a viral crowdfunding campaign before, and they raise way more money than they intended to. Also, unlike something like venture capital, you get to keep all of your equity in the company. And it taps into a community that can be your first users or customers. A lot of times with crowdfunding campaigns, those people that back it are the first ones to use your product or service. The cons, it requires a ton of time and effort and may require money to get it off the ground and be successful. Also, your campaign may not succeed. Less than 1/3 of all crowdfunding campaigns meet their goals. And also, you have to pay multiple fees on the money raised, and it only works for certain types of businesses. Not all types of businesses is going to work for a crowdfunding campaign. So you have to really figure out if that meets the needs for your business. The next is peer-to-peer lending. Peer-to-peer lending is a platform that matches borrowers and lenders. These loans are often a combination of many different investors. So what are the pros? The pros, super quick process. You usually get instant approval in many cases. You're going to have lower interest rates than many other sources, and the approval rate tends to be higher than traditional bank loans. Good, right? Well, what are the cons? The cons is you must apply for the loan as an individual. That means no business loans. It can also affect your personal credit score, something we never want to happen. Also, these interest rates tend to be a lot higher than your traditional bank loans. Next, I want to talk about small business grants. And I love small business grants because it's essentially free money, right? There are a surprising number of resources out there to provide grants to small businesses. And the pros to this is that it's essentially free money. Grants don't need to be repaid. This is really, really great for like cash-strapped businesses. The cons is it's super time consuming, guys. You're gonna have to do a lot of paperwork. It's very strict eligibility. The competition is fierce because there's so many people applying for these grants. And usually there's a long waiting time. It can take months for you to get an answer back. Also, QuickBooks customers can apply for loans from QuickBooks Capital, which offers small businesses funding you can apply for through the QuickBooks platform. QuickBooks reviews your business attributes and overall health from the details that you enter, as well as other relevant information. This lets them offer small businesses greater access to funding than many of the other lenders, especially the ones that I listed before. Before I get out of here, I do want to talk about two different programs specifically for Black-owned businesses. One is the Community Development Financial Institutions Fund. Wow, that's a lot. Let's just call it CDF, High Fund. This is part of the Treasury Department, and it aims to expand economic opportunities for underserved people and communities by supporting a national network of community development lenders investors, and financial service providers. The next one is the Minority Business Development Agency, or the MBDA. It almost sounds like the initials to a Kanye West album, I think. But anyways, let's keep it going. The MBDA, which is part of the Commerce Department, connects minority entrepreneurs to banks, mutual funds, and private investors, where you can apply for grants and loans. In addition, they run a network of minority business centers in most major cities where you can get one-on-one financial consulting and advice. Cool? Got it? We're good? All right, let's get to the questions. Thank you for all of the questions that you guys sent. I'm gonna try to get to as many as possible. So let's jump right in. What are the best terms for earlier investors, especially for amounts of 10K or less? Now, are you asking early investors if you want to invest? This sounds like a question for people that want to invest. I think a lot of times it's when you want to invest into your own business, or if you're asking for terms for early investors for your business, you have to really figure out what you value your business at, right? So when you start giving money away, taking money from investors, they're taking money from your business. So, you know, if you're valued at $100,000, or you value your business at $100,000, if someone puts $10,000 in, now they own 10% of your company. So it's really important to find out what is the valuation that you're seeking out from investors before taking that money. I think that's what you're asking. I hope that's what you're asking, but I'm not sure. But I hope that helps. The second question. How do you find financing? What are your recommendations for scaling your business? Well, I would look at all of the options that I listed earlier. In terms of scaling your business, the first start is establishing product market fit. Do you have a product or service that the market or your target audience actually wants? Also, identifying where your audience lives, right? To be able to market to them successfully and scale your business, you need to know where they hang out, whether it's online or in real life. And also finding ways to acquire customers through your budget, right? Like when I talk about marketing, you know, you have to understand what your budget is and what is possible through your budget. If you have $1,000 budget, you probably shouldn't be going and using that to try to buy a billboard. You should probably be thinking about other ways to scale your business. Once you find a successful channel and find where your audience lives, it's all about iterating and optimizing on those channels. And the more revenue you get, that's fuel for growth. So continue to iterate and build, and you'll be successful. What are the pros and cons of a business loan from a bank versus seeking out venture capitalists? I think it's really all about what works best for you. So with venture capital, you don't technically have debt. Like, so when you get a bank loan, you're in debt. You have to pay that money back. Technically, with an investor from a venture capitalist, you don't have to pay that money back, but it's pretty bad if they don't get an ROI on their investment. So technically, you don't have a loan. Also, venture capital is for people that are looking for large returns on their business. If you're creating like a lifestyle business where you maybe make a few $100,000 a year or a couple $1 million a year, venture capitalists aren't going to be interested in that. They want to see high return businesses on their money. They want to see their money 10, 20x. So that's not going to be right for all different businesses. But the great thing about a business loan is that you retain equity in your business. Like I said previously, when you start to take venture capital, you start to lose pieces of ownership for your business. Now, this is great for a business that is trying to scale and become bigger, but for all businesses, that is not the best option. Is it better to use a credit union or a traditional bank to get financing? Interesting. I started off with a credit union. I'm with a bigger bank now. It really depends. So, credit unions tend to have lower fees. They have better interest rates on savings accounts and loans for your business. While banks, they have the technology, they have the multiple locations, they have the mobile apps and all that good stuff that typically comes with a bigger bank. Banks often have more branches and ATMs, like I said earlier, but credit unions are known for better service, better customer service. And larger banks tend to have like stricter rules and less flexibility. So it really depends on what you want. Let's see. How do you finance an art LLC? Any resources you can share? I don't know what this art LLC is. I don't know if you're trying to sell art, if you're an artist yourself, if this is an art technology company. It really depends on what type of business that you're trying to build. If it's a art technology company, maybe you're looking to raise some venture capital. That might be the best route for you. If you're trying to open up a gallery, maybe a traditional business loan might be the best. If you're trying to do a project, maybe crowdfunding will be best. If it's something more in the nonprofit space, maybe grants. But it really depends on what you're trying to do. Feel free to hit me up if you're seeing this question, and I can help you out individually. Here's the last question here that I'm gonna answer today. As a creative, is having a business plan as important as perfecting your ideas first? There's one thing we say, or me and some of my colleagues say, is impact over perfection. One, do you have product market fit? It's something I spoke about earlier. Do you actually have a product or service that has a fit in the market that people actually want? Secondly, do you have the knowledge and the resources, including finances, to be successful, right? Like, when I got into the art space, for instance, I took a year to really learn the space and really learn the market before launching a business. I think it's really important to take that time. And lastly, are you willing to sacrifice and do what it takes to be successful? A lot of people aren't, willing to do that. And being a business owner is really, really tough. Most businesses come out with the MVP, which is a minimum viable product. So it's not perfect. It's not about building something that's perfect. It's always about iterating, but making sure that you have something that people find engaging and useful first is really, really important. And then creating that business plan, that, your go-to-market strategy and your marketing strategy and all those things are going to be important too. But you don't have to have something that's perfect, guys. With that being said, I wasn't perfect today, but I had an amazing time. I hope you found this useful. Again, my name is Everette Taylor. I am signing out with QuickBooks Ask the Expert series. Thank you guys, and good luck.